for Unit 4 of we've already completed Unit 1, Unit 2. I'll make Unit 3 later. We'll take Unit 3 at last. We'll go for Unit 4 and Unit 5 first, and we will discuss about in Unit 4 will discuss about corporate finance instruments. We've already dealt with this kind of unit in financial management before, and so it is very easy for you. We'll discuss about rights issue, bonus issue, term instrument, commercial papers, public deposits, intercorporate deposits, and innovative financial products. So these are the seven instruments. It's more of theoretical topic. We'll just go through it one by one. Mm. So rights issue, uh, it is the offering of new shares by the company in the primary market to its existing shareholders. What companies do is when they are going for any follow-on offers, like they are coming up with some new shares, before offering it to public, they offer it to their existing shareholders. It can be in discounted price as well. So it becomes an opportunity for existing shareholders that they can purchase the shares at a reduced price in a discounted price as compared to the market, and they can gain the benefit of capital appreciation. Now also they can also sell that in open market, going gaining through the price differential as well. So, rights issue, it is an offering of the new shares by the company in the primary market to its existing shareholders. Features, what are the features of right issue? It is preferential treatment to existing shareholders. Before offering it to public, company is giving it to existing shareholders. So it is preferential treatment to existing shareholders. Now traded same as normal equity shares, so they are normal equity shares only. The only thing is, before offering it to general public, it is given to the existing shareholders. So it is just kind of preferential treatment. There's no difference between rights shares issued through rights issue or and normal equity shares. Right issue is in proportion to existing shareholding. So whatever existing shareholding is of existing shareholders, on the basis of that, they will get rights issue. Existing shareholders may or may not exercise the right. So a company will offer it to existing shareholders. It is up to shareholders whether they want to take that share or not. So it is just it is a kind of facility given to them. They may or may not take it. Now merits a low cost of raising funds, because it is existing shareholders. There won't be any cost related to issuance as well, and giving it to public. So it costs less. Then no dilution of ownership because the shares are going to existing owners. So there's no dilution of ownership. Everyone will be having the ownership as they had before. Now certainty of offerings will be certain. There won't be you are also company is also free in its mind that it has given its share to the people who are already there. So that is not a problem. Now discounted price of shares, shareholders gain because they get prices less than the market price, and then they can make use of the differential pricing, or they can also uh, trade as if normal shares are traded, or they can go for holding that share and getting benefit of the capital appreciation in the future. Then shareholders prefer investment. So shareholders, why won't they prefer? Because they're getting shares in, or in the existing company, they're already holding that, and they don't want to dilute their ownership. Also they're getting it at lesser prices than with what they will be buying in the market. There will be differential pricing, and also capital appreciation will be there. So they always prefer to buy rights issue. And demerits can be issued by companies who have already issued the shares before. So it cannot be used by the company who are going for IPO first offer. So they cannot go for, this is not for the companies who are going for initial public offer, only to existing shareholders. So it cannot be given to debenture holders, it cannot be given to any others, it is only to existing shareholders. And wealth accumulated only in limited hand. So what it leads to is the wealth of the company, it is concentrated in few hands only. It doesn't pass on to other people. So that is one of the drawbacks. Then let's go for what is the procedure of right issue of shares. Company will decide the cutoff date Company will prepare draft offer and letter attached as annexure A. So there's annexure A which is there. Call and hold the board meeting and pass board resolution for approval of right issue and offer letter. Then authorize a director of company to issue letter of offer. So letter of offers are issued to the existing shareholders. Letter of offer shall be dispatched through registered post or speed post or through electronic mode to all the existing shareholders. Offer will be remain at least after 3 days of issue of offer, letter of offer. Offer will be open for minimum 15 days or maximum 30 days. Now receive the money from the shareholders. The shareholders who want to subscribe, they send you the money. Then again call and hold the board meeting. Present list of allottees before the meeting. Pass board resolution for allotment of shares within 16 days of receiving the money. File form of with ROC. So file pass with that is this is application form with the registrar of the company, and issue share certificate. Pass resolution for the issue of share certificate in board meeting. Authorize to two directors and authorize a person to sign the share certificate. Issue share certificate in form SH1 as per section 56. This is a form number in the format in which the issue share certificate is to be issued. Then 2 months from the date of allotment of the share. So it is a general procedure how company issues cut off. So what they will do is they will call for they will decide the cutoff date. Then by the time by what time they have to issue the shares, then they will draft offer of letter, then they will hold meeting, then they will authorize directors to issue letter of offer, then letter of offer is issued. Within 3 days that offer letter reaches to the existing shareholders. Give them 15 days to 30 days time so that they can review whether they want to go for it or not, and receive money from shareholders. Again call and hold board meeting. Present list of allottees. Pass board resolution. File form with ROC and issue share certificate. So these are the steps of issuing rights issue. So what they do is first of all composite issue. So rights issue, what is the procedure? First one is composite issue. So make everything or decide what kind of issue you want to go for, what are how many shares you want to go for, what is the amount of money you want to raise. Then appointment of merchant bankers. Decide on minimum subscription. What should be the minimum subscription? Preferential allotment. Make preferential allotment. Then underwriting means pricing of shares in so underwriters play a very big role over here. Rights of convertible debenture holders. If there is any convertible debenture, then what is their right and all. So, and no retention of oversubscription. So if there is oversubscription, then there should not be any retention of the money. It should be given back to the shareholders. Letter of offer. Send the letter of offer. Newspaper advertisement should also be given of the rights issue, and submission of compliance report. So submission of compliance report to the government bodies is to be done, to the regulatory bodies like SEBI. So next topic is a bonus issue. A bonus issue is also known as scrip issue or a capitalization issue. It is an offer of free additional shares to the existing shareholders. A company may decide to distribute further shares as an alternative to increasing the dividend payout. For example, a company may give one bonus share for every 5 shares held. So, what normally companies do, for example, company wants to give dividends to its existing shareholders, but the company is not having enough of cash to distribute dividends, but they do because they have gone for some recent investments which has taken a lot of money from the company. So what they can do is they can simply get permission and issue bonus shares out of their reserves, and reserves means it has to be from capital reserves. So bonus shares are issued out of the capital reserves, and then it is given to the st- bonus shares are given to the shareholders in the form of dividend. So like ठीक है, because you're not able to give you in cash, will give you in bonus shares. So that is the thing is there. The features, free additional shares to existing shareholders, also known as scrip issue or a capitalization issue. Why? Because it is mainly from the capital reserves in proportion to existing shareholders. So it is always given in proportion to existing shareholders. Merits, it results in the conservation of cash Under financial constraints, when companies lacking in cash, they can go for bonus shares. A remedy for undercapitalization is, there is undercapitalization, you can just go for bonus shares and increase your capitalization. Widening of share market, when you want to increase your shares in the market, you can just go for issuance of bonus shares. Economical, because you are not going for any expert and all, you're just distributing it to existing shareholders, and it is you're saving yourself from a lot of hassles before going to the market for new shares and all. So it is economical. Undistributed profit to the shareholders, so shareholders are also happy that they are getting something out of the investments they have made, and keep shareholders happy. Motivates existing shareholders. Increases security of creditors. Creditors are secured because here what they are doing is, you are giving your shares, whatever reserves you have, you are converting it into shares. So that is, share is something which your shareholders cannot means, it will never become zero. It has to remain what it is. It can never be taken out of the company's balance sheet. So creditors are also happy that okay, company is making more of investment, and it is not as liquid as reserves and surplus. So the shareholders won't be able to take it out, and they are happy to lend then. Increases marketability of shares, because there's number of equity shares increase, and so automatically there will be some impact in prices, and there will be more mobility, more of velocity in trading. So it will help in increasing marketability of shares. Then demerits, decline rates of dividend in the future, because very simple, because they're giving you bonus shares, so they won't give you cash, and they will always keep on giving you shares. Lengthy process in the sense, I won't because it leads to contradictory statements. But lengthy process as compared to what? Lengthy process when it because you need permission to issue bonus shares, because bonus share has to be from particular kinds of reserves only, it cannot be from all the reserves. Then it requires SEBI approval, because it can lead to frauds if you're issuing bonus shares from other reserves which are not allowed. For example, there are statutory reserves. Now, statutory reserves, you cannot issue bonus shares, and if you do that, that is illegal. So you have to take SEBI approval. Encouragement to speculative dealing. So what it does is it leads to speculative dealing. It leads to dealing on price changes. So and short-term price changes. So that is also one of the demerits of the bonus shares. Now, no company shall, pending conversion of FCDs, foreign commercial deposits, and PCDs, issue any share by way of bonus unless similar benefit is extended to the holders of such FCDs, PCDs through reservation of shares in proportion to such convertible part of convertible debentures. It is convertible debentures. These are all convertible debentures. So, if any convertible debentures are remaining, then no company shall, pending conversion of convertible debentures, issue any shares by way of bonus unless similar benefit is extended to the holders of this. So अगर आपके पास कोई if you have any convertible debentures, you cannot convert your you cannot issue bonus shares. If you are issuing bonus shares, then you will have to give same facilities to the convertible debenture holders as well. Convertible debentures are, what are convertible debentures? Over a period of time, because debenture is a debt instrument. So what companies do, they give facility to the debenture holder that after a period of time you will be made shareholder of the company, and your debentures will be converted into equity shares. So we cannot the company cannot just keep on issuing bonus share and keeping its debenture convertible debentures into on hold. The shares so reserved may be issued at any time of conversion of such debentures on the same term on which the bonus shares were made. Reserves created by revaluation of fixed assets are not capitalized. So any reserve which is created by revaluation reserves cannot be used to issue bonus shares. This is a very big thing, because there have been many frauds in when you go into history of finance. There has been a lot of frauds when revaluation reserves have been converted into bonus shares. That is why this law has come. The declaration of bonus issue in the lieu of the dividend is not made. So, declaration of bonus issue cannot be made in the lieu of dividend. Then the bonus issue is not made unless the party paid shares, if any existing, are made fully paid. If there is any partly paid shares, then that has to be fully paid. Then only bonus shares will be issued. The company has not defaulted in payment of interest or principal in respect of fixed deposits and interest on existing debentures or principal on redemption thereof, and has sufficient reason to believe that it has not defaulted in respect of the payment of statutory dues. So there should not be any default in the interest and payment principal of the debts. Plus, also there should not be any default in the payment of statutory dues. If there is any default, then this a bonus share cannot be issued. The company which announces its bonus issue after approval of the board of directors must implement the proposal within the period of 6 months from the date of such approval, and shall not have the option of changing the decision. So once it is approved by board of directors, then it has to be implemented within 6 months, and within 6 months it has to be implemented at any cost. Articles of association shall contain a provision for capitalization of reserves. Now, you cannot issue bonus shares unless and until it is allowed under your articles of association. If there is no such provision in the articles of association, company shall pass a resolution at general meeting making the provision of article association for capitalization. If there is no such provision of issuance of bonus shares in articles of association, then company has to pass a resolution in its general meeting to um, make sure that such kind of provision exists in article of association, that has to be included into article of association. And consequent to the issue of bonus shares, if the subscribed and paid up capital exceed the authorized share capital, a resolution shall be passed to the company at general meeting for increasing the authorized capital. If see share capital can never be above authorized capital. So if anyways your paid up capital exceeds uh, the subscribed and paid up capital exceeds authorized share capital, then the authorized share capital will have to be increased by a resolution, which has to be passed by company in its general meeting. So this is about the bonus issue. So it is very easy. See, it's mainly whenever you're going for convertible debentures, and convertible debentures are to be given due importance. They are to be first of all converted into equity shares. Then only bonus shares are to be included. If you're not converting the equity shares, then they should be given the same benefit as it is given to bonus shares. Then bonus shares shall be made out of the free reserves built out of the genuine profit. So it should be made only out of the free reserves. It should not be made out of any. It should be made of the genuine profit and share premium collected in cash only. So free reserves should be available. Free means any reserve which is not reserved for something else. And reserves created by revaluation reserves should not be allowed to be capitalized. And declaration of bonus issue in lieu of dividend is not made. Bonus issue is not made unless the partly paid shares are fully paid. Then there should not be any default in payment of interest and principal of the debt, as well as payment of statutory dues. Then in case if it is approved by the board of directors, then in next 6 months it has to be done at any cost. An article of association, if it is not having any provision, then you cannot issue bonus shares unless and until you include that provision in article of association through by passing a resolution in general body meeting. Then, consequent to issuance of share, if subscribed and the paid up capital exceeds the authorized share capital, then authorized share capital has to be increased in general body meeting through the resolution. So this is about the bonus shares. Now, term instruments. If you talk about the term instruments, commercial papers, public deposits, and intercorporate deposits. Commercial paper is an unsecured short-term debt instrument by a corporation, typically for the financing of accounts payable and inventories and meeting short-term liabilities. Maturities on commercial paper rarely range longer than 270 days. Commercial paper is issued at a discount from face value and reflects prevailing market interest rate. What happens is, what is commercial paper? It is a promissory note. It is a promissory note issued by a corporate, a well rated corporate, a good rated corporate, for taking some money from the people. So what it does is, it will make some promissory note, and on the basis of that promissory note they will be getting some money. They will be getting some funds from the market. And maturity, it can never be more than 1 year. And most of the commercial papers, they are not more than 3 months. So it is very short term instrument. Also, the face value, it is issued at discount. So if it is mentioned in its face value, for example, it is mentioned as 1,000 rupees, then the same will be discounted at 800 rupees, because it will be sold at 800 rupees, because that will be redeemed at the face value. So it is always issued on discount. Now, features, it is 7 days to 1 year. It can be no grade period. There cannot be any grade period. Grade period and promissory note. It is a promissory note. Renewal is not allowed. That has to be given. Grade period means there cannot be any time period which can be extended or which can be asked for. And minimum investment is rupees 5 lakhs in multiples. Types, promissory note can be there. Bill of exchange, check, certificate of deposits. So these are there. Then merits, alternate source of finance. It is an alternate source of finance, cheaper and convenient method, safe investment. Safe because it is issued by higher rated corporate only. Otherwise, that is not allowed. So because high rate corporates, the blue chip companies, they don't default. Normally, they don't default on their payments. So it is considered a safe investment. Cheaper and convenient also, because for company also, because they don't have to search anyone. It can easily be given to corporate deposits are also there. So that is how it does. Demerits are impersonal finance. Uh, Suitable for higher rating companies only. So what about lower rating companies? They don't get this instrument into their kitty while raising the funds. Restriction on different purchasers. There are different purchases. There are different restrictions. There are restrictions related to purchase, who can purchase commercial papers and who cannot. And no premature payment. In case if someone wants to make a premature payment, some company wants to make premature payment, they cannot. They will have to wait for the time when this will mature, and then only they can pay it back. So this is about commercial papers. Let us go for public deposit. Public deposits refer to the unsecured deposit invited by the company from the public, mainly to finance working capital needs. So it is directly borrowing from the public. Companies are directly borrowing from the public, and that too unsecured deposits. Means there is no security given for these deposits. Features, it is unsecured, accepted by companies. Minimum period is 6 months, maximum period is 3 years. Fixed rate of interest is year, and easy and simple process. So it is directly company to people. It is regulated deposit. There are two types of deposit: regulated deposit and exempted deposit. So regulated deposits are the deposits which are regulated by the SEBI. All the deposits are regulated by the SEBI, but regulated deposits are the deposits which are on eyes of the SEBI, and they take care of that thing. Then exempted deposits are the deposits which are not regulated, and they are mainly exempted. So SEBI is more confident about them, and they exempt these deposits. ठीक है, it's good. You can take money. Then merit, simple and easy, no charge on asset because it is unsecured, economical, it is flexible. Demerits are uncertainty, insecurity, lack uncertainty because unsecured hai, you never know what will happen in the future. Insecurity always prevails because there is no security. Then lack of attraction for professional investors. Professional investors, they don't get attracted of this because they don't offer that much of return when it comes to if you talk about trading in the stock market also, etc. Then uneconomical, hindrance to growth of equity market, because if companies start taking deposit directly from the public, then they won't go for equity market. They'll rely more on the debt part, because nobody wants to share the ownership part of the company. Then over capitalization, it will sometimes, because it is easier method, what companies do, they over capitalize themselves. They unnecessarily take loans from the company, from the people, and that is not recommendable. Intercorporate deposits: and intercorporate deposit is an unsecured borrowing by the corporate and financial instruments financial institutions from other corporate entities registered under the Companies Act. So it is company to company deposit loans. Then company having surplus fund would rent to another company need other funds. So what normally companies do is, if in case a company is having some issue with the fund management, for example, some loan is maturing and they are thinking about the things like what will happen, and they don't have cash, and there's another company which is having funds in surplus and they are looking for better avenues for investment, and they are not able to invest into other things, and they are looking for better avenues, then they can lend that this company B can lend it to company A and can take money from in the form of interest to them from them. So what are the features? It is convenient and hassle free source of finance, simple procedures there, because company to company, variable interest rate, risk of uncertainty, though it is always there. Nobody can say that anything is certain. Then there is no regulation, because company to company it is there. Functions on the foundation of personal contact. So if someone is having personal contact, good personal contacts, then they can easily go for these loans in the company. Then high risk and high return, short term funding. Types are 3 month deposit, 6 month deposit, then call deposit. Call deposits are 15 days deposits. Then 15 rate fixed rate ICD, intercorporate deposit with call put options. So these are the options. Option to buy is call and option to sell is put. So these are fixed rate intercorporate deposits with call and put options. So option can also be given that okay, we are giving you this, but you have the option to buy or sell it. Then floating rate intercorporate deposit with the call and put options. So these are the five types. So 3 months, 6 months, 15 days, and fixed rate ICD with call put option, floating rate ICD with call put option. The merits are deployment of surplus of funds. So the company which was having surplus of fund, anyways, it was wastage for them. It was loss of revenue for them, because they are keeping cash with them, so they can safely deploy their fund to and give it to some other company which is which actually wants for the lack of cash, and overcome short-term financial crunch. Convenient process, a convenient process. And demerits not structured, that is the biggest problem. It is not regulated, not structured. Minimum lock-in period. Most of the companies, they keep minimum lock-in period, that you can claim ICD after 3 months or 4 months only. For example, these 3 months deposit, you cannot claim them before 3 months. Then leads to virtual control over companies. So the company giving funds may take over virtual control over these companies. And interest rate risk is there. Interest rate risk is always there wherever interest is involved. Interest may go on higher side or it may go on lower side. Especially the biggest problem which company face here is when it goes to floating rate of interest. Because if the rate increase, then the rate will, if the market rate increase, then the interest rate on this ICD will also increase. In credit default risk, there may be companies who may not revert back with your money. So always credit default risk is there, because any company may default on your money. So that is how it is. Now let us go for innovative financial products. What are the innovative financial products? First one is floating rate bond. Floating rate bond is bond with market rate of interest, whatever market rate of interest is going on. So the interest rate on this bond is floating. Zero coupon bond. This is a coupon bond which is issued on discount on its face value. So these kinds of bonds, for example, on its face it is maintained 100 rupees, so it will be discount for it will be sold for 90 rupees, and it will be then redeemed at face value. Then deep discount bonds, are very cheap bonds. For example, there are a lot of discounts available on bond. The bond of it is available on very less price as compared to what is given on its face. And revolving underwriting financing facility. So underwriter may also give some finance facility to the shareholders, and this is revolving because it is flexible. Auction rated debentures. So there are debentures which are auction rated, and they are priced as per the auction made by the people who are desperate to take those debentures. Then secured premium notes. There can be premium notes. There can be notes which can be issued, and those notes are secured by the asset of the company which is issuing those notes. Non-convertible debentures with detachable equity warrants. So there can be non-convertible debentures as well with detachable equity warrants. Then that will be equity warrants. They can go for equity warrants at any time. The security zero interest, partly convertible, secured zero interest. So zero, first of all, it is secured, means it is secured by the charge on the asset of the company. Zero interest means there is no interest, because interest, and no interest means always it is issued on discount. Then partly convertible debentures. There can be partly convertible debentures. Convertible means over a period of time, some amount of the debenture which has been issued, it will be converted into equity shares, other will remain as debenture only. With detachable and separately tradable warrants. So there can be detachable and separately tradable warrants attached to these partly convertible debentures with secured zero interest partly. Then fully convertible debentures with interest. There can be fully convertible debentures. Fully convertible debentures means the debentures which are fully convertible over a period of time into equity shares, and by the time means when till the time their debentures, interest will be given on them. Then differential shares. There can be shares given in a differential form. Securitized shares. Shares with some securitized format. It can be given in securitized format. Then collateralized debt obligations. There are collateralized debt obligations. Their company may CDO is a big thing. I'll talk about these things more in detail, because there can be obligations which a company can take, and they can be collateralized as well. Collateralized means there can be secondary security which is backing these instruments, and they are CDOs. Inverse float bonds. So there can be inverse float bonds. The float bonds which have floating interest rates, and perpetual bonds, bonds which are redeemable at infinity, which cannot be redeemed. They are only paid, the interest is paid, the only interest is paid till infinity. Municipal bonds, these are bonds issued by local bodies. And masala bonds are Indian bonds. When they are issued in foreign market, they are known as masala bonds. So these are some of the innovative financial products. And so here we come to end of the fourth unit. We will go for fifth unit tomorrow, and then we'll complete our third unit, and that will be end of the corporate strategic corporate finance. Thank you, and thanks for now. Thank you.